we are going to go ahead and get started. Thank you so much for joining us for today's webinar. This is the 1071 update, rethink, refocus, and realign. My name is Jessie Taylor. I am the Senior Director of Fair Lending Products here at RiskExec. And I'm joined by my colleague, Sarah Brons, a product leader here at RiskExec as well. And she oversees our 1071 and CRA product development. Now, a few housekeeping items before we kick off on our content. You will see that the chat is available. So you guys go ahead, tell us where you are watching from today. You will also see a Q&A section. So we have opened up Q&A for this webinar, but we do not anticipate on being able to get to many, if any, of the questions today. But please feel free to submit questions to us, and we will follow up with you after the fact. So with that, let's go ahead and get rolling. So we are talking about the proposed rule, the 1071 update that came out just about a month ago. Now, we've been talking to many of our clients over the past several months about what their 1071 programs have looked like. And we heard really the full response, full gamut of responses from different institutions. Some had not even started, some had paused. Many, especially I think the larger institutions, had really kept the initiative rolling. So our goal for today, we want to help all of you on this call understand what has changed in this latest proposal. We want to talk a little bit about how to potentially pivot or re-engage, maybe if you had paused, and talk about the impacts of those changes. So with that, I'm going to pass it to Sarah. Sarah, do you want to give us a little bit about the regulatory landscape itself?
You bet. Thanks, Jessie. I am going to take down our shared slides. They'll come back up a little bit later in the presentation, but for now, when you see those go down, just know that that was intentional. As Jessie mentioned, we're going to talk a little bit about the background here, but a lot more about what's changing and what you can be doing. So I think just to kind of reground us, it's important to understand the small business lending rule, or Section 1071, as it's known by in the history there. So Section 1071 was a part of the Dodd-Frank Act. It was intended to create transparency around small business lending, essentially creating a requirement that had more detail and more transparency into lending transactions, and specifically small business lending, kind of like we think about the Home Mortgage Disclosure Act for mortgage lending. Really, the goal of this rule was to illuminate the factors that surround credit access for small businesses. And the intention there was, again, to create visibility around who's applying, who's getting approved, and where the gaps might be. To give some background, so this rule really takes us way back almost to the inception of the Dodd-Frank Act, but I'm going to just go back a couple of years to 2023 when a final rule was issued. So we're already almost 3 years from the date of the first final rule. When that rule came out, it did what the CFPB had said it was going to do. It applied to banks, credit unions, fintechs, and alternative lenders. There were a few key features of the original rule. So there were tiered thresholds for reporting. The lowest threshold was lenders who were making 100 loans, or again, applicable credit transactions per year. The rule required 80 data points, depending on how many principal owners there were involved in the transaction. There were tiered compliance dates. So for all those various thresholds that were set, there were 3 different tiers, and then they subsequently started reporting at different times. And honestly, it really represented one of the most significant expansions in small business lending oversight that we'd seen. Many of us are familiar with the Community Reinvestment Act and those requirements, but those are really limited when you think about small business lending and all the factors to consider. This rule was significantly expanded like nothing we had seen before. Almost immediately, there was litigation and there was various challenges made to the rule. Really what ended up happening was a lot of deferral of the reporting dates. So we saw several times where original dates were advanced into the future, and even submission dates were advanced. put institutions kind of in a very unique place. Some partially built systems, some paused that work. We'll talk a little bit about that today. But there was really a lot of uncertainty as the dates continued to get advanced and institutions were deciding kind of how to respond each time the dates changed, leaving a lot of us saying, what do we do now? So that brings us to where we're at today. So in November of this year, so just about 3 or so weeks ago, the CFPB, current CFPB, issued a notice of proposed rulemaking, making adjustments to that published final rule. And we're going to talk in more detail about what exactly was there, but the idea there was that the CFPB said we're going to scale this back to what was originally intended by this requirement. Again, still bring transparency to these transactions, but the data collection is going to look different. So that proposal was issued on November 13th of this year, has a 30-day comment period, and that comment period closes in 5 days. So if you're an institution that's thinking about putting in a comment, just know you've got a handful of days left, and you have some time here to think about what you might say if you are putting in a comment. But I'm going to talk a little bit more now about what exactly is changing in this particular proposal. So again, we're in that place where we're looking at a proposal. There's a handful of things I think are really important to highlight. And in fact, the CFPB just held their winter consumer advisory board meeting. Some of the same things we're talking about here are going to be that were touched on in that meeting, but there were changes to the coverage and scope of the requirement. So certain credit transactions that were previously a part of the requirements are not included in this proposal. Merchant cash advances are removed, ag lending, and even small dollar credit, so credit in less than $1,000, are all potentially excluded. The reporting threshold changes. So I mentioned earlier that originally it was 100 credit transactions would lead you to become a reporter. That threshold would now move up to 1,000 originations. That's a pretty significant change. And what that ultimately does is it really removes quite a few potential reporters from the mix of this type of data. Farm credit system lenders would also be excluded from the reporting requirements. Again, the requirement's going to change basically who reports, which ultimately leaves the largest small business lenders as reporters for this requirement. Another significant change was the definition of small business was adjusted. So originally the threshold was at $5 million of revenue was considered a small business. Now it's being backed down to 1 million in this proposal. It does align better with some of the SBA micro business definitions, also aligns with the Community Reinvestment Act thresholds that, again, many banks are familiar with. So you see a change in the threshold that really identifies a reporting institution. And ultimately means, again, fewer mid-sized borrowers are going to be included. So the focus is more on true small businesses. Another element that'll change or potentially change is the type of data fields that are included. So in this proposal includes the removal of many of those original elements, again, 81 total. So removes pricing, denial reasons, LGBTQIA, ownership, application method, number of workers, and some other discretionary fields. So a lot would be potentially coming out of this requirement. I think Jesse will spend some time talking about that, what that could mean for analysis that you might want to perform with this data. Some things that will stay would be core demographic and business information. Depending on how you look at this could make this rule more manageable to implement, more manageable to work with your borrowers on collecting this data. But it does really, there's a great deal of de-scoping when it comes to the data fields that we originally saw and expected to have included. Lastly, I think it's really important to mention the implementation timeline. So we're no longer looking at tiers of institutions. It's that 1,000 transaction threshold that makes an institution a reporter. And then everyone becomes a reporter on the same day. So single compliance date is January 1st, 2028. No more thinking about different dates depending on your volume, which could be helpful. It provides a unified date for all reporting institutions once they know that they've become a reporter. So with that, that's kind of your walkthrough of what we're seeing change. at this point, I think Jesse and I are going to talk through some of I guess, what to think about when you are, what to do now. So I'll hand it over to Jesse.
Yeah, absolutely, Sarah. And I think if you want to bring up that slide, and while Sarah is doing that, I just want to make a comment and call out. Sarah mentioned how even when that 2023 rule finally came out, there was a lot of litigation, different injunctions. And so there is certainly an anticipation that both this 1071 rule and the additional proposed rule that the CFPB dropped in the same time on some ECOA changes, there's definitely an expectation that there's going to be that same process, right? We're going to see litigation, we're going to see some challenges. While the consistency is great as far as the date goes, we'll see what is to come. But I'll also just call out that I expect we're talking to mostly compliance professionals on this call. And so even when we hear a date like January 1st, 2028, that will be tomorrow before we realize it. So there are really a wide variety of reactions here. And I'll call out, I had a discussion with a client just a couple weeks ago, and we discussed specifically this rule. And they found themselves in a situation where they had fully expected to be required to comply with this law. But now that the threshold had been raised, they are no longer thinking that they will meet that 1,000 loan threshold. So now all of a sudden they have work that they have done, but they are not as immediately impacted by the requirements. So that is, of course, the first thing that every institution should do. If you did believe you were subject to this rule, you need to assess the threshold impact. Moving from 100 to 1,000 is a pretty large change, and there's a large percentage of the population is going to be basically not captured with these new thresholds. So not only should you look though at your obviously current volume, but it's really important to evaluate the expected pipeline growth. So I'll reference that client again in that same conversation. This was actually a relatively new business that they were spinning up, and they expected to be getting 700, 800, 900 loans in the next couple years. So they're recognizing, hey, while they might not be immediately impacted by this requirement, of course, their goal would be to grow that business. And so therefore, they don't want to scrap what they've already done. So they are continuing to look at those requirements and see what makes sense to hold on to and what makes sense to continue moving forward with. And of course, it's important to really discuss all the different entities within the organization and find out what volume, which different arms of the businesses are doing, in case that that combined product mix can trigger that threshold in a way that you weren't really expecting. So I'll let Sarah talk a little bit about the product mix itself.
Thanks, Jesse. Yeah, that's an important piece of this. So we're obviously seeing the types of transactions that are included in the rule potentially change. So this is a great time to look back through any of the work that you did previously and understand where you have reportable transactions or where you previously had what you believe were reportable transactions, and take a look and understand if they're impacted by any of the exclusions that are now outlined in this rule. It could mean that you are going from being a reporter to not, or being closer to that 1,000 transaction threshold. So it's really important to understand what transactions are essentially changing and which ones may not be reportable in the future. This is a time to look at your loan origination systems and your intake workflows and understand what you should be doing differently there, especially as it relates to your product mix. So you still want to make sure that you're collecting this information where it's required for those reportable transactions. It's also up to you to decide if you want to remove any unnecessary data capture for excluded products. I think most would likely do that. You have work to do with your lending teams and your credit teams, so they understand their responsibilities. And I think you have to know who you're working with and decide how you're going to approach that. But ensuring that they have clarity around what's reportable and when they need to collect certain information is going to be an important part of your role. And I think again, this is a good time where you do want to work with those lending and credit teams and make sure you're really spending some time, maybe dispelling myths of what they've heard or what they think is changing. You want to be the one that's giving that education and providing that clarity. We know this is a proposed rule, but considering the short comment period, it's highly likely we're going to see a final rule that looks like this. So now is a time to start getting the message out, sharing with your teams what to expect and what they can expect from you as a representative in the institution. I'll talk a little bit about mapping these fields. So again, you've got a proposed rule, so you certainly have that opportunity to look at what was in the final rule, what's proposed, what's still going to continue to exist. I'd recommend keeping things like the infrastructure around the NAICS code, time in business, number of principal owners. So there are some valuable fields to that, of course, you still want to keep in there. This is a place where you can think about those discretionary fields that are potentially coming out. Think about how you would want to handle those, but I would wait until you have an actual final rule issued. So make sure your project plans are updated about what maybe potentially you're going to do, but definitely wait until you have a final rule. And just think about continuing to be flexible while you're waiting and ensure that you can make adjustments quickly. Now, we do have a couple of years before reporting would start, but we know from experience that it took time for institutions to stand up potential processes. So you want to make sure you're ready when it's time to report on those requirements. So with that, I'll hand it back over to Jesse to talk about that last pillar, maintaining readiness.
Yeah, absolutely. So I think I'm really just piggybacking off of what Sarah just said. It is important to maintain those existing project plans and governance structures until the final rule is released. And again, we'll keep an eye on what those what litigation and challenges might look like as well. It's important to not lose work that you had already done, even though you know that some of that may be sort of streamlined and diminished with what this latest proposal has. So it's also important to document assumptions, dependencies, and the optional components so that adjustments can be made quickly. And I'll talk a little bit more about that in just a moment. And then, of course, there is some simplification aligned with that single January 1st, 2028 implementation date. So that is definitely, I think, a headache that a few of us in compliance were sort of struggling with, which is, okay, if we do file these partial years, all of that sort of struggle that we're trying to jump through different hoops to find the best way to comply with. That at least is simplified in this. So one would hope that even if these get pushed out, that simplification would remain, but we'll see. So coming back to those optional components and really looking at what has been collected. So it's important here to partner with your technology teams, your vendor teams. We here at RiskExec, we have had that 1071 module available for quite some time. And obviously that was built with the expectation of the expanded data that was going to be required. So it's important to keep in touch with any vendors, including loan origination systems or potentially systems that you were building internally on how to capture that data and confirm those processes, make sure what is and is not going to be required. And make sure that you've got some flexibility there with the data mapping since there is still some uncertainty around this. It's really important in that process to maintain version control and audit trails so that you've got continuity between what was being implemented and at the end of this project, it's all coming together as you need. But then I did want to talk a little bit about the fair lending implications here. So remember, the original intent of this was to enable testing of minority-owned and women-owned businesses with an expectation that those businesses were potentially being treated unfairly, right? Whether that was more frequently denied or priced differently. And so I remember the days of HMDA testing fair lending in the fair lending space when we had all of 26 data fields in HMDA. And so at that point, and even when the HMDA data expanded to the current 110 version, I'm not sure I know of a single institution that doesn't add data even to the 110 fields to enable better analysis. So even though some of these fields have been removed from this proposal, there may still be value in retaining that information down the line to enable the testing that ultimately this rule was initially intended to enable. So it's important as you are reviewing what does and does not need to be collected that you take that into consideration. Um, Again, I think we're at a crossroads here in the fair lending space where institutions really have to decide who they are and what's important. And are you going to continue doing the right thing because it's the right thing to do? And frankly, as well, what are the business opportunities that are being missed if this data is not being looked at from that perspective? We know that I think every financial institution at the end of the day, you want to make as many good loans as possible. And so this data historically and currently is still something that we can look at to identify where are gaps in your lending, that there may be opportunities to provide more credit to different populations. So at the end of the day, we don't know what the testing will look like here. I will say that especially amongst those institutions who did continue implementing 1071, they are looking already at that fair lending testing capability. So it's important to stay mindful of that. So with that, hopefully we've left you with a few steps and what do you do right now? So most important, step one, you've got to look at that coverage and threshold analysis, look at the different products and see, is it still relevant to your institution? Are you still going to be required to comply with that new date? Update any implementation roadmaps. So for those that were continuing this process, there might be some pivots involved. For those that maybe had paused, it might be time to dust that off and take a look at what makes the most sense in how to restart. We talked a little bit about internal communication, making sure teams are aligned in their role. It's also important, of course, to escalate those executive communications, right? We want to make sure that there's executive alignment across all of those businesses. So that is an important component of moving forward as well. And then, of course, you've got system testing, parallel data collection, pilots. So take a look at that data and make sure it has the integrity before you do any of the advanced testing. And then, as we said multiple times, monitor for that final rule adoption and any potential actions coming out of the litigation. Sarah, I'll pass it back to you.
Well, thanks, Jesse. Well, I hope we've left, like you said, some good points for you to think about as we are preparing to respond to seeing a final rule. We've spent a lot of time on this rule over the last few years, either waiting for updates or waiting for clearer information, and it looks like we're going to have something here going forward. So, take what you've done thus far. If you've continued your planning, you'll be in a place to make updates. If you need to dust that off, this is a good time to look at it. Just keep in mind that this proposal doesn't undo all of that work, it clarifies it. So anything that you can do to kind of keep the process going is going to be valuable when we are looking at a final rule. I said it a little bit ago, but I'll say it again. You have a comment period that's still open right now. So if you're interested and your institution has the appetite, this is still a time when you can submit those. You have until the 15th. But now's the time again to think about that planning and think about your governance and how these processes are going to look and work with some changes. But again, you're still going to have a rule where the small business lending requirements that applies to you.
Absolutely. With that, just a reminder, if you do have any questions, please feel free to reach out to us. You can also follow us on LinkedIn. We will be publishing content based off of this, and you can stay connected to us. And lastly, we do want to invite you to register for the 2026 Fair Lending Forum. That will be in New Orleans in April of this coming year. So this is an Assurity event with RiskExec as a premier sponsor. So you will see several members of our team, and we are really excited about this upcoming event. So we look forward to seeing all of you there. And we will get back to, we did have a few questions that came up, so we will make sure to respond to those following this event. Thanks so much for spending time with us today, guys.